Thank you, Alexandra. And now we have Mitali Das from the Fiscal Affairs Department of the IMF.
I'd like to thank Daniele, the foundation, and the many people who've put together this excellent program, and thank you for having me here. I'm an economist from the International Monetary Fund, and my talk is going to fall very much on the economic side of the pandemic. In particular, I'm going to speak about the composition and scale of government spending, so-called fiscal policy, on fighting the pandemic, and this fiscal programs, which would go on to become the largest fiscal spending in history, at least going as far back as data is available. And questions about what enabled the magnitude of this fiscal response, can it be repeated in the case of future shocks, and what are the legacies of that spending? This presentation is based on the paper we submitted to the symposium, which I've written jointly with Vitor Gaspar, former director of the Fiscal Affairs Department at the IMF. So here's a small preview of the presentation. Let me start by just giving the sense that despite the very high mortality cost of the COVID-19 pandemic and the excess deaths and other such disastrous things that many people have spoken about, there is still a general acceptance that the economic, health, and social policies that governments deployed were successful in the sense that they averted what could have been truly very disastrous outcomes. And we ask the question, did this happen because we were prepared or were we lucky? In this paper, we argue that the success owed much to luck. On the health side, years of related medical research that converged just at the right time. And on the economic side, decade of low inflation before the pandemic that kept interest rates low, and that became critical to support this large government spending. And the third one was the hard-won credibility of major central banks. Our point being that these fortuitous conditions may not emerge in the future, and they serve as a reminder that future pandemics could be much harder to fight. We set the scene, as many have done, I see before me, with Ambrogio Lorenzetti's fresco, The Allegory of Good and Bad Government, which tells an important lesson about the fragility of governance, which is that even stable governments with strong democratic institutions cannot withstand shocks that are sufficiently large and disruptive. Lorenzetti's message was prophetic in the 1300s when the governing body of Siena fell apart following the outbreak of the Black Death. Its rulers had been in power for decades, but during the pandemic, they fled to the countryside and they left the masses to fend for themselves in a ruined city with no administration. They lost legitimacy, they were swept from power, and just as Lorenzetti's fresco had warned, peace under good governance quickly gave way to ruin under tyranny. Lorenzetti's lesson, we say, is it repeated itself half a millennium later during the COVID-19 pandemic. When COVID-19 deaths or COVID-19 related deaths rose, voters treated it as a failure of governance and punished those in power, even if it didn't come from mismanagement. I think Dr. Pagnallo touched on this issue yesterday as well. And you can see this in two different ways in these figures. What the left-hand side figure shows you with time on the horizontal axis since the outbreak of the pandemic and the change in government approval ratings on the vertical. In blue, where you have low case growth countries, and in pink, the high, you see that government approval ratings fell more, where infections were higher. And on the right-hand side, you have COVID deaths on the horizontal axis and the vote share in national elections on the vertical. And what this tells us is that incumbents who were in office in 2020 and ran again in 2024 received a lower vote share in countries where COVID-19 deaths were higher. And that political fallout of the pandemic needs to be viewed against the backdrop of governments' somewhat misplaced confidence about managing the pandemic. Countries around the world were very confident about their preparedness for the next health crisis, but they entered the pandemic with tools that turned out to be less effective than desired once they were tested. We spoke yesterday about the Global Health Security Index, which had been developed as something to benchmark countries' ability to detect and respond to these outbreaks. They ranked the US and the UK very high at of global readiness, but both countries would go on to record some of the highest per capita mortality rate. And as this figure indeed shows you, countries with higher health securities, as measured in 2019 before the pandemic, had paradoxically higher mortality rates due to COVID by 2021. I'm not a health scientist, and so much of our work is drawing on other people's work. And scientists also took comfort in a very rich suite of epidemiological models, particularly the SIR-based models, which had actually very successfully forecast the path of other outbreaks, such as the seasonal flu. And because these SIR models fed heavily into the work done by leading global health institutions, such as the US CDC, they also carried this weight of institutional authority. But even though these models could provide broad insights about pandemic dynamics, they had some trouble when you had abrupt shifts in parameters, such as lockdown policies and unanticipated human behavior that couldn't really be anticipated very well, and the virus's mutations. And as the left-hand side figure, which is from a paper by Charya and others, shows the actual count, which was in red, deviated quite a bit from the predictions of a very large number of SIR models that the CDC use. Furthermore, the right-hand side figure, let me just summarize what it does. It shows the accuracy of these models, and it shows that the accuracies diverged even more with successive waves. Nevertheless, one unquestioned success of managing the pandemic was the extraordinary speed of vaccine development, as Emmanuel and Edward also spoke about yesterday. From the time of the World Health Organization's declaration of a pandemic in March to the first regulatory approval in the UK in December, only 8 months had elapsed. Whereas the left-hand side chart shows you that the average time between the detection of a pathogen and vaccine authorization in the past had been, since the 1800s, was 50 years. In fact, in October 2020, when the US CDC, using a combination of forecasting models and expert opinions, did its work, it predicted that a vaccine was likely to be available by 2023, as shown on the right-hand side. So this was an unquestioned success. But the scale and speed of that vaccine rollout, like much else in the pandemic, relied on fiscal firepower. And this brings me to the central economic story that I'll go to. So fiscal policy became the first line of defense against the virus. In a typical crisis or a typical recession, fiscal policy has a very clear role. It's to boost spending and to stimulate economic activity. But in a pandemic, that's the worst thing you can do, because you want to reduce activity to the absolute minimum so that contact is minimized. So fiscal policy in the pandemic was not traditional stimulus, but it was repurposed in 3 ways. The first thing it had to do was to fund an enormous health response. This was everything from the development of vaccines to expanding hospital capacity to testing and the rollout of PPEs. The second was to provide lifelines, transfers to protect workers and firms from the income losses that they couldn't insure against. You wanted to keep them home, but you wanted to make sure they could eat. And the third was to stabilize, not stimulate, but stabilize demand just enough to prevent economic freefall, right? To put a floor on the drop in activity. And I'm not going to go into the details of this figure, but the main point is to show how different was the composition of spending in the pandemic relative to, let's say, the global financial crisis, which is more of a typical recession. And with the heavy focus that we had on health and these direct lifelines, which are the bits shown in orange and purple, much bigger in the pandemic than in a typical crisis. But fighting the pandemic was not cheap. Governments saw revenues, as they do typically collect from taxes and customs, collapse because activity stopped, but expenditures exploded. And on the left-hand side, you see how much government revenues in percent of GDP declined relative to the pre-pandemic year 2019, where we've normalized 2019 to be at 0. And on the right-hand side, you see how much government expenditures rose. And what you see is not just that they rose, but the scale of the decline in revenues is much smaller than the explosion of spending. And that difference between revenues and expenditures is the budget deficit, the government deficit. Expenditures were orders of magnitude above revenue, and they created large deficits and the greatest increase in government debt since the World War II. In the US, in just 2020, government debt rose by 20 percentage points. And that kind of increase is extremely rare. It's only been seen during the world wars, and it even eclipsed that. Other advanced economies follow very similar patterns. One of the things that economists worry about is whether government spending of this magnitude can trigger panic in the financial markets. And this usually happens because investors, people like you and me, who lend to the governments to finance that kind of spending, get worried that if governments owe so much, they will become bankrupt before they're able to repay. So investors, people like you and me who hold this government debt, who lend to governments, demand a higher risk premium, a higher compensation to lend to these governments, and that's what causes interest rates to go up. That's our payment for lending to them. But despite the surge in debt, which is shown on the horizontal axis, the change in interest rates shown on the vertical scale was tiny. This was extremely small changes, smaller than in normal times. And why? Why was that? And this, the point that we make in the paper, is because the governments had the luck of entering the pandemic under extraordinarily favorable conditions. A decade of low inflation, low interest rates, and years that had taken to build high central bank credibility. So policy rates in most major central banks were around 0, or what we call the effective lower bound, the ELB that's referred to in the title of this slide. Let me say a few words about that. So in the decade before the pandemic, major central banks struggled with low inflation. It was too low. It was far lower than the targets, and even intermittent deflation in countries like Japan, which is shown in the left-hand side curve. Governments struggled to get them up to central banks' targets. Too low inflation is not a good thing. And in an effort to raise inflation, they deployed every toolkit in the toolkit, from conventional and unconventional monetary measures, which included large-scale asset purchases. You may have read about it in the language quantitative easing, forward guidance, and they lowered interest rates till they couldn't lower them anymore. And some countries like Switzerland and Denmark even went into negative interest rates. And by end 2019, as you see in the right-hand side, interest rates were under 1% in 90% of the advanced economies. And that would turn out to be a very lucky break because governments could borrow cheaply, with the interest rates being the cost of that borrowing, and that made it possible to deploy this large fiscal support. But that luck would reverse quite quickly. As lockdowns lifted and inflation began to surge, driven by the supply bottlenecks, the pent-up demand from governments giving these large transfers to people, and the energy crisis because of the Russia's invasion of Ukraine, it brought about a cost of living crisis whose effects we continue to feel today, whose effects were consequential for the US elections. So this inflation hit the poorest households hardest, and this figure shows to you the effects of this inflation between the lowest and the highest income households, measuring the kinds of things that lower households consume and the prices of those and how that rose. So while low interest rates and low inflation help central banks deploy a large fiscal package, it had these costs when inflation rose later, but even then it came with a benefit. And that benefit was that high inflation eroded the value of debt. Sort of a technical, nerdy point, but that's what high inflation does to debt. And so coming to the last slide, let me end by saying that even though fiscal policy during the pandemic, it was decisive, it saved lives, it has left adverse legacies because the transfers that were given were distributed very unevenly across households, sectors, different firms. Lower income and informal workers suffered large and persistent losses, and after decades of successively lowering poverty every single year, poverty rates have increased every year since 2020, which you see on the left-hand side. The fiscal policies also fueled a boom in the equity and housing markets, and this widened wealth disparities, which is shown in the middle. And public debt is at the highest it has been in human history, which is shown on the right-hand side. And the social and economic imbalances whose seeds were sown during the pandemic are going to shape the policy landscape for decades to come. And let me end there. Thank you.